Hello traders, Nick Shaheen here looking at Alphabet Google GOOGL ticker, the Google, not the Goog. It's got two tickers, people forget that. One company. Okay, so time to go long, time to go short. What's the deal? I was debating this with a couple of friends, and the answer is it depends on your time frame and your goal. If I'm looking to invest, first of all, before I forget, at the end there'll be a subscribe to this channel button on the left hand side that comes up. Click it, it's free if you're not already a subscriber. Okay, so as far as advice, there's no advice here. I'm just speaking my mind and my opinion. First of all, the stock markets in general are near all-time high, so there's always a risk to the downside from those levels. Add to it the fact that we are in headlines trade. Mind you, the headlines that are in the ticker tape are not game-changing. So we have a tariff war with China, big deal. It's not a huge amount of money. But for the short term, the stock market trades on the headlines. So homework is slave to headlines and overrides the homeworks for the short term. Okay, having said that, this is a daily chart on Google. And not too long ago, I said it was tight. We had lower highs, higher lows coming into a point, and I said something will happen. I said, I don't know what, but I will watch the breakout or the breakdown, and here are the two scenarios. The breakdown came first, but it didn't play out. They broke down leg one, and then leg two, they went up and decided, you know what, we're going to go up. Don't know if there were headlines there or not. Doesn't matter. The triggers were there. Where it stopped made sense because this was a neckline from which they had broken out before the last earnings. So machines trading, they remember levels, so what was support or what was resistance becomes support, as they say, just because it just means there's action around that level. So here we are trying to come back and reestablish that same level as support. And last week we had a few drops right here, and surprise, surprise, found footing at the same, I mean, like to the penny. Let me mark it up actually. If you watch these videos often, you've heard me say that. Let me mark it up. Okay, so this was last week's. By the way, today is 10/8. And look at this. And look at this. Accident scene. They clawed their way back into it, failed, boom, right? On a headline. But the failure was exactly where we found footing and was about where we found footing before. So if I extend it left, this level plays back. Look. You can argue these two also. We'll extend time frame to see how far back this level goes. So this is where it's support until it's proven otherwise. So we may fall the next few days, do this, and then if we lose it, there'll be consequences. But if we don't, I assume it's support. So if I'm long until, if I wanted to put a stop loss, this would be a place I'd put it. But it also depends on time frame. So is it time to go long up here? Again, it depends on time frame. So I'm going to close that and try to answer. So if I was a short-term investor, a daily chart is not enough for me to decide whether I should go long Google or not. Let me go down to a 2-hour chart time frame. So this shows a candle for 2 hours. Every candle is 2 hours, I should say. So this is where I can say, you know what, I have some things to look at here. So the same bottom, if it goes below this, I'm out. Because if you look at it, it looks like a head and shoulders, inverse cup and handle, whatever. I'll mark it up in a second. As far as chasing upwards, 1206 will be a place to start chasing above this candle right here, or above this candle, this bunch right there. Why above? Because this bunch have been proven as resistance for this short period of time until otherwise. So just for the same reason I said this would be support, I say this would be resistance until the bulls prove to me that they can go above it. Quickly, here's how we would look. same chart, different time frame. So I would put a notification, like an alert, wake me up when they go above it. Ideally, I want to see them go above it and then come back to it to use it as support. Because this was a scene of a crime, an accident scene. They were walking, they tripped. They came back to it, they couldn't do it. If they come back to it, I want to see them go above, come back to it, and move up. Okay. Important to note that this is a point of control, meaning for this period of time, which is August through, this zone right here was most active. This is a volume profile. And specifically, this point in time, this level, not point in time, level, where bulls and bears fought it the hardest. So this cluster right here and this action right here account for a lot of volume. So even though this is looks like it's a lot of volume here, but the point of interest between buyers and sellers is more acute up here for this period of time. So this looks like a solid floor, and it is, but it's also, this for the same reason, this is a solid resistance until it's no longer, right? So now we have a tight region where the stock is ping-ponging. What does that mean? It means if it breaks out of it, let's draw a box around it. So if it breaks out of it, it carries in that direction. So if it breaks down, it's going to carry down, and this will come back into play. You know, here when they broke down, they averted finishing the job because of this said support right here, the cluster. So this box, when they break out of it, either down or up, they're going to carry in that direction. Okay, here there'll be resistance also. So this is how I would decide. So do I buy it or sell it? I don't. I'll put an alert. You know, I'll say add alert, remind me, and then I'll get the alert, and when it pops up, I'll decide whether it's worthy or not. Now this is like an ABC, so we'll put us to 1240 if this happens. You know, I just can't imagine they're going to come to a deal this week, and I can't imagine that the stock market's going to be happy with it. But oh, I forgot. So where's the risk on the downside? You guys and gals have heard inverse head and shoulders or head and shoulders, and this would be the opposite of it. Now, I'm not a technician, but I do know how they work. It's a neckline. You can draw it at several different places. To me, it's a neckline. You know, they attacked it, it survived, it survived, it survived. And then they came back to it, it survived. Well, eventually, if it doesn't survive, meaning they go below it, that means the buyers are tired of defending the neckline, and the sellers were overwhelmed and overshoot. The mathematical, you know, it should overshoot by this much. It should. To me, I look left. I'd say they're going to try to stop it right here first. So this would be a place where they would stop, and if eventually they get to here, it's fine. So that's how I would do it. I put an alert. I can put an alert to short. Now this is kind of a funky tail right there. This was 10, is that? Anyway, 10-3. Don't know what happened that day, but that's kind of a funky tail. Tails like this should be pretty strong bottoms. It all depends on the volume profile for that day. I haven't checked it. Because they went down to it, but immediately decided that's wrong. Let's go. It doesn't mean they're not going to get there and decide that it was right. We don't know yet. This is soon to be determined. So going back to a daily. So this is for the fast trader. For the slower trader that invests in stocks rather than trades, there's nothing wrong about it. Just maybe the daily chart is better and not enough in my opinion. Okay, so clearly we have a wide range. So here the value area is lower. And so the other one, we had a value area that was a little bit higher and a point of control that's a lot higher. So in this case, of this whole period of time, which is about a year, this is where all the action took place, this bulk of it, specifically this line right here. So gosh, 1180, 1178, 1179, the zone down here has seen the most action. So if I were to bet my life on support, it should be somewhere below this. So if I were to sell naked puts, I would definitely want to be below that. Ideally, we want to be below the June low. Ideally, I want to be below the Christmas crash. So if you think the Christmas crash was terrible, then there's no reason why we should come back to it. Why? Because now we have the Fed on our side. And so if I have higher lows, look at that. I didn't plan it that way, but if I connect the higher lows, look at where they intersect, somewhere around there. So if we fall for whatever reason, there's going to be a decision to be made at X market, 1078, 1080, 1070, 1090, somewhere in that region. It's a moving target. Time is going to tick, and the market's going to change. The moving target is going to change for both lines. This orange line, which is the point of interest, point of control, based on volume, and actual the trend line. So if I draw a line here to connect the higher lows, usually I like levels that are horizontal because they're actual levels. I can marry to the volume profile, but in this case they come together, kind of a deal, the orange and the red. So if the what hits the fan, it's going to come into play. So if I'm looking to go long and I don't have any longs in it and I have other longs in the market, then I'm not rushing into buying Google right here, especially not going into earnings. So earnings is usually mid to late October. In this case, I bet you in the last week of the October contracts. So if I were to sell puts or put spreads, I would want to be ahead of that. I don't want to hold it. And taking a lot of risk on earnings is a crapshoot. It is an absolute coin flip. I don't care who you tell me you're tracking, how much homework you do. The next open on earnings +1 is an absolute coin flip. Even if they hand me the P&L, I couldn't guess with certainty as to which way the market is going to go. It would be a gamble, no different than going on a roulette table and say even or odd, red or black. So I can do homework to try to get smart about it, but it would be for the longer term. The immediate reaction is a complete coin flip. I may be able to prove it to you. Here's an up move. Here's a down move. Here's an up move. Here's a down move. So there you go, 50-50 right there. 2 up, 2 down. I can do homework to try to improve my odds, but it's a complete coin flip. 40, 60, it's all the same to me. It's a coin flip. Anything around 50-50 is a coin flip. 55, 45 is, it kills me when the experts come in. I give it a 40% chance. Well, nothing better, not a lot better than a coin flip. So thanks for the help. In this case, short-term reactions are complete coin flips. So I can't justify going long unless I have a longer time frame. And for that, I would rather do something else. So I'm going to go to a weekly chart. All right, so this is a weekly chart. I'm going to take out all the drawings. So if I were deciding to be long Google, I'd say, for the last 5 years, whoever was long Google made money. For the last 2 years, they kind of went sideways, but with a lot of gyrations, which will probably mirror the market too. So when things go up, they go up and then they consolidate, and then they go up and then they consolidate. Nothing goes up forever. They go down. By consolidate, that means they chop. So if I think about it, if I go to a monthly chart, so definitely if I held Google from the origin, from the start, I made money. So this trend should continue unless Google is going off the rails. Now I do worry about Google from Facebook, but I'm long Facebook, so I can choose to be long Facebook and Google to hedge my bet there. Okay, so here we are deciding if it's good long term. So looks like there was a period of consolidation right here, and then meander, some sort of a consolidation right here. People call it a flag, a pole, and then a jump, and then if you consider this a base, this was a run and another run. So they went up, they consolidated and fizzled a little bit. Eyeball, one can argue that this was a 50% fib, and this is the 50% of this extension, and then they gave it all back up to the Christmas crash. So here we go. Okay, now good thing I went to a weekly, because now I have a level. a confirmation of a level that I can bank on. What is it? This little flag right here is where markets chose to bring Google back on the Christmas crash. Boom, the Christmas crash. Well, not the Christmas crash, sorry, the 2018 correction from February. Remember we had a jobs report and it was too hot. TNX ran up. Oh my gosh, you know, we are going to, inflation is going, the Fed is going to be tightening or whatever, and the markets corrected off of the Friday jobs that was too hot, and the TNX was approaching 3%. CNBC had a special, TNX is, the world's going to stop rotating if the 10-year goes above 3. And now they're begging it to get above 1.6 or whatever it is now. So my how we change, right? So this is the Christmas crash, which was a confirmation of that tizzy that we had that started the whole thing in February 2018. So two bangs against it. But it's not a coincidence because of this little box right here. And so to me, this is a bankable bottom. You can argue that this was here. So if I were selling puts to generate income, I'd be very comfortable selling it down here. And I bet you I can sell the December one and still collect about $3 to $4. I haven't checked for premiums, but I bet you I could. What does that mean? It means I sell a put for $3. I promised to buy shares at that price. I basically would have sold somebody insurance. If somebody owns stock, say, I want out of my stock if it goes below 900. And I'll say, you know what? I'll sell it to you. I'll buy your stock at 900 if it goes below 900. Give me a premium. They'll give me a premium of $3 per contract. I haven't verified these. I'm going from gut. Okay, so December, January, I bet you I can find them down there. So there is risk, but there's also, it's better than buying the shares up here and hoping for a rally. This way I'd have eyeball 20-25% buffer from current price to $900 where I'd be on the hook. So my losses don't start until 900 minus $3 if I get paid $3. So that's how I would rather go long Google right here, because then I would leave room for all of this junk to play out. And the difference between this bottom and now the situation is that here the reason was China plus the Fed. Because we were okay with the China thing until the Fed came out and said, hey, we're on autopilot to be tightening. And then we said, what? Whoop, the market went down. And this time, this was not here. So we still have China. Same problem. It didn't grow. We didn't start importing more. So the balance is still, the math is still the same. What's at stake is the whole shebang from China, which is 550 billion, give or take. So tariff the heck out of it, it's the same number. All right, so it's nothing new. The only thing new is this guy. Okay, so I do have friends that argue that we're at the tail end of a cycle. Maybe, but cycles last a long time. I don't want to hope the cycle is ending and start shorting things willy-nilly, because I can guarantee you that we could wake up, if there is a deal in China or a can kick, we will have a relief pop. Now, relief pops I would short, but it might be big enough to where there are so many people so comfortable short over here above current prices in the stock market in general, in Google, in everything. You see people like Dan Nathan, they're so comfortable shorting and all their stops are still not triggered above here. All it takes is one or two dings against it, and then whoop, they hit their stops, and then there'll be another leg a lot higher that would raise eyebrows. Just like this could happen, that could happen. We can't crash up, but we can really rally higher. I'm not calling for it, but my thesis is that the stock market in general is not done. It should hit 3,200 plus. We say, oh my God, you're crazy. It's not that far off. Every piece of news we're getting in the headline is negative, and the game is still almost tied. We're still at all-time high. Why? The VIX is in the 20s. Why are we still up here? So until I find out otherwise, I'm going to assume that we're just biding time to blow up. And maybe it's the last burst. I don't know. But there's no evidence to tell me that Apple is going to get a haircut to be only making half as much as it's making now. There's no evidence to tell me that Facebook is going to fall off a cliff. The first 5 stocks in the NASDAQ are more than half, almost half. They can't be more than half, then they'll have to reweight it. Let's say the first 6 stocks are more than half. You've got Facebook, the FANG, Apple, and Microsoft. So are they in danger to be cut in half? No. So the bottom is near. That by definition. In my opinion, I could be wrong, but this is just the back of the envelope saying, okay, so how can we not fall off a cliff? Because the P&Ls are still healthy. They would need to be, this is FANG. I'm going to add to it plus Microsoft plus Apple. All right, this is FANG, Microsoft, and Apple all together. What needs to happen for these stocks' earnings power get cut drastically to where justify a huge dip that is sustainable? So 30% down. What's going to cause them to come down lower than the crash of Christmas when things were so bad and the Fed was not behind us? Okay, today the Fed told us that they're buying T-bills. So he went out his way to say it's not QE. Well, it sure sounds like QE to me. But anyway, Facebook, I don't even use you. So it sounds like QE. He says it's not a QE. He's not buying bonds. Fine. Okay. And so, but the point is that the Fed is in the corner of the economy, in the corner, and the stock market is a big part of it. People hate it when they do something like that. But hey, anyway, it cuts both ways. All right, this video is a lot longer than I wanted, but I started talking about Google. Is it time to go long Google? The easy answer is it all depends on the time frame and the intention. If I intend to own it for a long time, why don't I buy a few shares and hold it, or sell a few puts in order to buy the shares? How does that work? Again, the puts and calls are options, tools that I could use to hedge and or enter stock. People don't think about entering stock using puts, but if I'm looking to buy Google right now, why wouldn't I get paid for the promise, for the opportunity to buy it at 10% lower? So I'm long Google right now without being long Google out of pocket. Does that make sense? If it doesn't, let me know. We can have a special case.